Got some really impressive numbers, a 5% year-on-year revenue growth.
And net profits that just blew past expectations.
But with any financial report, there are also some areas that might raise a few eyebrows.
Right, things like the cost-to-income ratio ticking up slightly.
Something to keep an eye on, for sure.
Neat.
Well, luckily, we have our expert here to help us break it all down.
Happy to help.
Yeah.
I think what's really interesting is that OCBC managed to pull off such a solid performance this quarter, despite some potential challenges in the market.
Yeah, that's a great point. So where should we start?
Well, I think we should start with the foundation. Revenue and profitability. Always a good place to begin.
Okay. So the report shows a 5% jump in revenue compared to the same period last year.
It's not bad at all.
And a 14% surge in net profit.
Yeah, that's way beyond what analysts were predicting.
So what's driving these impressive numbers? What's the secret sauce?
Well, a big chunk of that profit boost comes from their non-interest income.
Non-interest income. Can you explain that a bit more?
Sure. So it's basically the money OCBC makes from things other than just interest on loans.
Okay, I'm starting to see the bigger picture.
Things like insurance, selling investment securities, and fees. Those areas really performed well this quarter.
Makes sense. But I did notice that their net profit actually dipped slightly compared to the previous quarter.
You're right. And that brings us to the cost-to-income ratio, which ticked up a bit to 37.8%.
So for those of us who don't speak fluent finance, can you break down what that ratio actually tells us? Should we be worried?
Think of it this way. It's basically a measure of how efficiently the bank is operating. It tells you how much they have to spend to earn $1 of revenue.
Okay, so a higher ratio means?
A higher ratio means their costs are rising faster than their income.
Oh, not good.
Right. Now, a small increase like this isn't necessarily a cause for panic, but it is something to keep an eye on, because if it keeps going up, it can definitely impact their profitability down the road.
Right, so keeping costs under control is key.
Exactly.
Okay, so let's move on to something that's obviously crucial for any bank. Net interest income, or NII for short.
The lifeblood of banking.
The report shows that NII was basically flat compared to the last quarter, which is kind of surprising because their assets and loans actually grew. So what's going on there? Why didn't NII increase along with assets and loans?
Excellent question, and you've hit on a key point here.
Yeah.
While OCBC did see growth in their assets and loans, their net interest margin actually shrank.
Their net interest margin.
Yeah, we call it NIM for short.
Right.
It's basically a measure of the profitability of their lending activities.
Okay, so their NIM shrank, meaning?
Meaning the bank is earning less interest on the money it lends out.
Right.
Relative to what it pays out on deposits.
So even though they're lending out more money, they're not making as much profit from it. Why would that happen?
Well, there are a few factors at play here.
Such as?
One is the growth in lower-yielding assets. Think of it this way. If you have some money to invest, you can either put it in something risky that might give you a high return, or you can play it safe and put it in something that's less risky but probably won't give you as much of a return.
Makes sense. So it sounds like OCBC is being more cautious with their investments right now.
Exactly. They're leaning toward safer, lower-yielding assets. And we also have to factor in those market rate movements, which have been putting downward pressure on loan yields.
Oh, yeah, I've been hearing about that.
Basically, the interest rates that OCBC can charge on some of its loans are getting smaller because of what's happening in the broader market.
Interesting. And I'm guessing this is all connected to why OCBC's management has been hinting at possible interest rate cuts in the future.
You got it. They're anticipating more pressure on their NI in the coming months, probably due to those rate cuts. They've actually revised their NI guidance downward to the lower end of the 2.2% to 2.25% range.
Okay, so some potential headwinds on the horizon.
Perhaps.
But let's not forget about that impressive surge in non-interest income. A 12% jump year on year. What's fueling that growth?
Well, like I said earlier, non-interest income is really flexing its muscles this quarter.
It sounds like it.
We're seeing strong performance across the board, particularly in insurance and steady growth in those fees and commissions we were talking about before. But the detail that really jumps out at me is that 63% leap in net gains from the sale of investment securities compared to the previous quarter.
Whoa, hold on. 63%. That's a huge jump.
Yeah.
What's the strategy there? Is this a one-time thing? Or are they changing their approach in some significant way?
Yeah, it definitely makes you wonder what they're up to. Are they trying to free up cash for something big?
Like what?
Maybe a strategic acquisition or a major investment in a new area. It's definitely something we'll be watching closely in future reports to see if this trend continues.
For sure. Now, let's shift gears a bit and talk about credit costs. Because what happens with those credit costs can really tell us a lot about the overall health of a bank. The report shows lower credit costs this quarter compared to the last one. That's usually a good sign, right? What's the story there?
Right. So if you dig a bit deeper into the numbers, you'll see that they had what are called write-backs in general allowances.
Write-backs.
Yeah. Basically, they had previously set aside some money to cover potential loan losses. But it turned out they didn't need as much of that money as they initially thought. So they were able to add some of that money back into their earnings.
Okay, that makes sense.
And these write-backs actually help to offset higher specific allowances, resulting in lower total allowances overall.
So that suggests that the bank is actually seeing fewer loans going bad.
Exactly. Their overall credit quality is looking pretty good. And the report also mentions a lower rate of new non-performing assets forming. Think of those as loans that are starting to look a little bit shaky.
Got it. So fewer loans are going bad.
Plus, their NPL ratio has declined.
NPL ratio.
Yeah, it's the percentage of loans that have actually gone bad. And it's gone down, which is a good sign.
Okay, less risk.
Plus, their allowance coverage has improved to 155%, meaning they have a nice, healthy cushion to absorb potential losses. Even if the economy takes a downturn, they're well prepared.
So they're being cautious and building up their reserves. Smart move. Now, one area that really stood out to me in this report is wealth management. OCBC had $6 billion in net new money flowing into the segment during the quarter. That's huge. What do you make of that?
It's definitely a sign that this part of their business is thriving. They're clearly doing something right when it comes to attracting and managing wealth for their clients. And this ties in perfectly with their broader strategy of really focusing on wealth management as a key driver of growth for the bank. They've been pouring resources into this area, and it looks like it's paying off big time.
Yeah, $6 billion is nothing to sneeze at.
Absolutely not.
It also makes me wonder if this success in wealth management is influencing some of their other strategic decisions. Like, remember how we were talking about capital allocation and the possibility of a special dividend? Could those things be connected in some way?
It's definitely a possibility. It's like they're putting their money where their mouth is. They're seeing strong growth in wealth management, so it makes sense that they might want to free up even more capital to fuel that growth. And that could mean returning some capital to shareholders, maybe through a special dividend.
Okay, so maybe they're using this potential special dividend as a way to show their confidence in the wealth management segment, like a vote of confidence.
Exactly. We believe in this part of our business so much that we're willing to share even more of the profits with our shareholders. But of course, we'll have to wait and see what they ultimately decide to do. It's still early days.
True, true. But before we get too carried away with all this dividend talk, I do want to go back to those specifics in the report for a moment. We were talking about net interest income, or NII, and how it was flat quarter on quarter despite the fact that their assets and loans actually grew. What else can we learn from those numbers?
Sure. So one thing that stands out to me is the impact of market rate movements on what we call loan yields. The report mentions a tightening of these loan yields. Essentially what that means is that the interest rates OCBC is charging on its loans are getting squeezed. And this is partly due to external market forces, which are outside of OCBC's control. So this is a good example of how banks aren't immune to the broader economic environment. They have to constantly adjust to what's happening in the global economy. And this pressure on loan yields is playing a big role in that NIM compression that we were talking about earlier.
Yeah, it's a good reminder that there are always factors at play that are completely outside of a company's control. Speaking of adjustments, can we revisit those credit costs for just a moment? We talked about all the positive signals, the lower credit costs and the improving asset quality. But I'm curious, what are some of the potential risks or challenges that OCBC might face on the credit front?
Well, like with most things in life, there's always a flip side. Things look pretty good for OCBC right now. But, the global economic outlook is still uncertain. And if there's a significant economic downturn, we could see more loans going bad. Even with that healthy allowance coverage they've built up, a large increase in bad loans could still put a dent in their profits. So it's a bit of a balancing act. Things are positive, but it's important to be aware of the potential risks as well.
Yeah, it's about being prepared, both for the good times and the bad times.
Exactly.
Okay, now I want to circle back to our discussion about non-interest income. We were highlighting how strong their insurance business was, but what about some of those other components of non-interest income, like fees and commissions? What can you tell us about those?
Right, so fees and commissions are like a reliable engine for OCBC. They generate a steady stream of income. And this quarter, we're seeing solid growth in this area, particularly in things like loans, trade finance, guarantees, and remittances. But there is one tiny blip on the radar. Wealth management fees actually dipped slightly compared to the last quarter.
Really? That's interesting.
It's not a huge drop by any means, but it's definitely something worth noting, especially since they're so focused on growing that wealth management segment.
It's like finding a tiny crack in a seemingly perfect diamond. Might not be a big deal, but you still want to take a closer look just in case.
Exactly. Sometimes those small details can reveal a lot about what's happening behind the scenes.
Okay, so let's address the elephant in the room. We've been dancing around this potential special dividend for a while now, but let's get down to brass tacks. What are the key factors that will determine whether or not OCBC actually decides to distribute that excess capital from GEH?
Right. Well, it's tough to say for sure. It's a bit like trying to predict the weather. There are a lot of variables at play.
Okay, but what are some of the main things they'll be considering?
Well, first of all, there's the regulatory environment. There might be certain rules or restrictions in place that limit how much capital they're allowed to distribute. So that's a big one. And then there are their own internal needs and growth plans. If they see a really good investment opportunity, they might decide to hold on to that capital instead of giving it back to shareholders. It's all about striking that balance between rewarding shareholders in the short term and investing for long-term growth.
That makes sense. Tough decisions.
Absolutely.
Well, let's zoom out for a moment and think about the bigger picture. We've been dissecting OCBC's second quarter earnings report, but what does it all mean for investors? What should they be taking away from all of this?
At the end of the day, I think it's fair to say that OCBC has delivered a pretty solid performance this quarter.
Yeah, I'd agree with that.
They've got a lot of positive momentum, especially with that strong non-interest income growth.
And the fact that their credit costs are down is a good sign.
Right. But they also have some potential challenges ahead, like that compression in their net interest margin that we were talking about. And there's still uncertainty in the global economy. It's always a bit of a risk-reward situation.
It always is.
But I think OCBC's strategic focus on wealth management and their commitment to smart capital allocation suggests that they're well-positioned for the future.
Yeah. And then, of course, there's that possibility of a special dividend, which always sweetens the deal a bit.
Absolutely.
Well, folks,